Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Thursday, February 14th. There are better things one could have done in the latter half of 2007 than recommend a retail stock. Undeterred, though, we introduced several retail ideas to our readers that struck us as good long-term investment opportunities. Footwear company Skechers, whose stock symbol is SKX, was one of those ideas. Our support for Skechers was predicated on the view that the market had overreacted to the company's disappointing second quarter earnings results and third quarter guidance. With respect to the latter, we noted that the disappointment wasn't linked to weak demand, but instead to increased expenses that needed to be incurred to meet growing demand for Skechers' products. That wasn't such a bad state of things in our estimation, particularly from an investor standpoint, since the higher expenses were the byproduct of a company being in growth mode. Taking this growth outlook into account, we concluded shares of SKX were attractively priced, trading at 11 times estimated 2008 earnings, particularly with the company holding nearly $5 per share in cash and short-term investments and virtually no debt. SKX has seen its shares of ups and downs since then that mirrored the market's overriding concern about the potential for a consumer spending slowdown to drive the economy into recession. That concern still exists today, yet the end result is that SKX is up 12% since we recommended it last September. In light of its fourth quarter report and first quarter outlook, we'd still be buyers of the stock today. The company posted net earnings of $12.1 million or 26 cents per diluted share in the fourth quarter on net sales of $302 million. That was down from $14.6 million or 33 cents per diluted share and net sales of $304.5 million in the year-ago period. For 2007, net earnings per share increased 3% to $1.63, while net sales jumped 16% to $1.39 billion. A tough comparison combined with the closure of some underperforming brands and a decrease in its domestic business that stemmed from a slow U.S. retail climate contributed to the fourth quarter declines. The downturn, however, is not as bad as it seems. Many of the company's customers elected to book closer to season, which effectively moved shipments from the fourth quarter to the early part of the first quarter. In other words, the business did not necessarily go away, it just got pushed out a bit. Skechers indicated its current backlog is up 29% year over year. In turn, its first quarter guidance reflects a better situation, with earnings projected to be in the range of 57 cents to 62 cents per share, and net sales to be between $385 million and $395 million. The midpoint of these guidance ranges translates to expected growth of 11% and 13%. The company's guidance, it should be noted, assumes no further deterioration in the retail environment. Now, there can be no guarantees a bottom has been hit, but looking further out, there is a light on the retail horizon that emanates from stimulative monetary and fiscal policies. For Skechers in particular, growth prospects are visible with its expansion into international markets, namely China, where it has a joint venture that is expected to start impacting sales later this year, along with the relaunch of its business in Korea. The company did not provide a full-year outlook, but first call consensus estimates for earnings per share and net sales currently stand at $1.96 and $1.59 billion, up 20% and 14% from 2007. At its current price, SKX trades at 11.8 times estimated fiscal '08 earnings, which is a substantive discount to the projected earnings growth rate. This relationship exposes the stock's value-oriented appeal, which is further heightened by the understanding that it has $6.15 per share in net cash on its balance sheet. Market sentiment will drive this consumer-oriented stock over the near term, but the price looks right for the longer-term investor. I'm Pat O'Hare for Briefing.com. Thanks for listening.